It's Brian Decker with your Market Minute, Top 12, the Dirty Dozen of 2024, the IRS top schemes that have fleeced retirees from a lot of money. This next one, relying on incorrect tax advice from social media. We kind of covered that last time. They hit it again, but we just don't trust social media to give you good tax advice. Monetized installment sales. These transactions involve the inappropriate use of installment sales rules by a seller who, in the year of the sale of the property, effectively receives the sales proceeds through purported loans or other transaction manipulation. In a typical transaction, the seller enters into a contract to sell appreciated property to a buyer for cash and then purports to sell the same property to an intermediary in return for an installment note. The intermediary then purports to sell the property to the buyer and receive the cash purchase price. Through a series of related steps, the seller receives an amount equivalent to the sales price. The seller thus claims a deferral or complete avoidance of the income tax resulted with the sale. It's not even legit. So want to warn you of that one. That's a monetized installment sale. Here's scams focused on high income filers. Tax avoidance strategies are promoted to unsuspecting high income folks with too good to be true promises of reducing taxes or avoiding taxes altogether. Here's 3 examples. Improper art donation deductions. Promoters encourage taxpayers to buy various types of art, often at discounted, quote-unquote, prices. This price may include an additional service from the promoter, such as storage, shipping, arranging, the appraisal, donation of the art. The promoter promises, falsely, that the art is worth significantly more than the purchase price. These schemes are designed to encourage purchasers to donate the art after waiting at least 1 year and to claim a tax deduction for an inflated fair market value, which is substantially more than what they paid for the artwork. Promoters may even arrange for certain charities to take the donations if you go that route. We just want to warn you that that's all false. Here's a second example. Syndicated conservation easements. This is something that's hit DRP clients. In an abusive syndicated conservation easement, promoters take a provision of the tax law allowing for conservation easements and twist it by using inflated appraisals of undeveloped land, or a few specialized ones, the facades of historic buildings, for example, and by using partnership arrangements devoid of legitimate business purposes. These abusive arrangements attempt to game the tax system with grossly inflated tax deductions and generate high fees for promoters. I'm going to go to a 4th segment to cover the rest. This is Brian Decker. Hope you have a great rest of your week.